Here are some of the stocks that the market hates right now. So in today's video, I'll be covering some stocks, and of course, I own United Health. So United Health just released their earnings. I own around 4.7% of my portfolio in United Health, and this was their earnings reaction. So the stock is currently down around 4%. It is currently trading at an 11 times earnings, giving out around a 3.3% dividend yield. So for United Health, their earnings were quite bad, so it is worse than expected, and the company anticipates its 2025 adjusted earnings of around $16 per share, with revenue of 445 billion to 448 billion. Wall Street analysts had expected 2025 adjusted profit of $20.91 and full year revenue of 449 billion. So they missed on both estimates, and that's why the stock is down today. So if you were to look at the guidance as well, the company is guiding for around $14.65 of EPS this year, of diluted EPS. So that puts that PE ratio at around 18 times at today's price. So it doesn't really look as cheap as what it was maybe 2 days ago. But of course, the PE ratio alone can be deceptive at times. So for United Health, this is the new valuation for the company, assuming a $14.65 EPS and assuming an 18 times earnings multiple. This company today will give you around a 12% return. So for United Health at today's price, if you have a short time horizon, it seems like a bad deal, of course. But for this company, if you're buying into it today, it is a company that will take some time to recover. So for United Health, it is not pretty, of course. Their earnings were disastrous, but it will take time for the company to recover. The company is undergoing transition, same for the entire industry. So if you don't have a long time horizon, then maybe this stock isn't for you. But of course, for all your different healthcare insurance companies, they operate in a short tail insurance business model. Basically, what that means is they can adjust the prices next year because the insurance that they provide are short term. So for United Health's case, they'll be repricing a lot of their different insurance next year. And when that happens, the company can be expected to have growth again next year. Same for all your different other healthcare insurance companies. The next stock that I'll be covering today is PayPal. So PayPal is down around 8% today. It is currently trading at a 16 times earnings. So for PayPal, this was their earnings. So their revenue beat estimates by 2.5%. Their total payment volumes beat estimate as well. And overall, it looks like a decent quarter for PayPal. So this is a snapshot of their Q2 earnings. So revenue went up by 5%. Total payment volumes went up by 6%. Transaction margin went up by 7%. And overall, this was a decent quarter for PayPal. So for PayPal, they also raised their guidance. So they're raising their guidance to around $4.90 of GAAP EPS. That's around an 11 to 14% growth year on year. So the company is also spending a lot of their cash on doing buybacks. So the free cash flow will be between $6 and $7 billion, and the share purchases will also be at around $6 billion. So the buyback right now will be at around 9% of the entire company's market cap. So you could easily see this company basically getting double-digit returns over the next few years if they continually buy back shares. So for PayPal, the company is slowing in growth and the moat is weakening, but the stock is really cheap at today's valuation. They will do similar to what AutoZone does, basically do buybacks and buybacks and buybacks. But of course, if you're buying into a company, you want them to buy back shares on top of having a good business. Because if the company is not high quality, then they won't be able to have their predictable earnings in the future. And of course, all these buybacks will stop when the company basically weakens in terms of their moat. So if you think PayPal will stay around for a very long time, then their buybacks are great on top of the growth of the company. But for me, I'll be staying out of this one. I think PayPal is facing a lot of competition today, and I much prefer companies like Visa as well as MasterCard. The next stock that I'll be covering today is Novo Nordisk. So Novo Nordisk is down around 22% today. It is currently at its 52-week low. The company is trading at 14 times earnings, giving you a 3% dividend yield. So for Novo Nordisk, they actually lowered their guidance this year. They lowered their guidance before their actual earnings. So they were previously expecting between 13 and 21% sales growth this year. And they were also expecting 16 to 24% operating profit growth this year. But they slashed their guidance. So their guidance now is between 8 and 14% sales growth and between 10 and 16% profit growth. So for Novo Nordisk, this is what an investor actually said. So they said that the magnitude of the guidance cut is a shocker, adding that Novo's risk went deeper than compounded copycats to Wegovy. Novo has been hit by copycat versions of its weight loss drug, mixed or compounded by pharmacies. A crackdown on legal compounded versions of Wegovy in May could improve the situation, although Novo said illegal compounding is still continuing. So there is terminal risk when it comes to all your different pharmaceutical companies due to the duration of their patent, and that's the risk with the company. So there's a risk when a company's patent expires, and in Novo Nordisk's case, a Wegovy drug will end in around 2032. So beyond 2032, you will see drug prices for your Wegovy coming down, and that will hurt the margins for the company. So you're basically assuming no growth in the Wegovy segment from 2030 onwards, and that's why the stock market is so bearish on this company. Besides that, they have 100% in weight loss drug, whereas their competitor, which is Eli Lilly, has a much wider scope in terms of the pipelines. So Eli Lilly is less prone to terminal risk as compared to Novo Nordisk, and that's why Novo Nordisk is selling off so hard today. Your compounded versions will keep coming in because they cost a lot lesser than the actual Wegovy drug. So imagine in the US, you're paying thousands and thousands of dollars for a Wegovy drug as compared to your normal GLP drugs, which cost a few $100s. So that will continue being a problem for Novo Nordisk unless they reduce their prices. The next stock that I'll be covering today is Spotify. So Spotify is down around 11% today. It is currently trading at a 95 times earnings. So for Spotify, their earnings weren't great. So the company report a loss of 42 cents as compared to earnings of $1.90, which were expected. The company reported revenues of $4.19 billion as compared to the $4.26 billion expected. So the revenue for the company actually only increased by around 10%, and that is the problem for a company like this. So for Spotify, the valuation today just doesn't make sense. I mean, the company is currently now slowing in terms of growth, and for all these high PE companies, the problem with them is when you see a slowing in terms of growth, all these companies will have their multiples being compressed as well. So that is a double whammy when it comes to all these different stocks. And for Spotify, although I view it as a decent quality business, I think the company is priced at too high a valuation, and there is definitely the valuation risk when it comes to owning Spotify stock today. And that's why I don't think it is a buy at all at this price. It needs to halve in share price before it gets interesting again. Next portion, I'll be covering some questions left in the comments. So the first one, it says, I just find your channel. Great work, my friend. I really enjoy your videos. Can you do a video about Copart? Thank you in advance. So this is what Copart does. They're involved in your salvage car transactions. So when a car gets into an accident in the US, what happens is your insurance companies, they'll try and determine whether or not the car is considered a total loss. So a total loss is considered when the car repair cost is greater than the car sale price. And when that happens, they will pass the car to Copart, which will help to sell the cars on that platform. So for Copart, this is one of the mode of the business. The company has a lot of lands near cities where your accidents happen the most, and they've been building up this part of land over the past 20 years, and they've spent billions and billions of dollars trying to acquire all these different lands. So this is a barrier to entry for anyone trying to steal Copart's market share. Even their competitor, which is IAA, they don't own any of the lands, they lease the lands, so there's a risk of them losing access to the land in the future. Whereas for Copart, it is impossible because they own the land, they have the land written in the books, and they will be allowed to continue using the land in the future. So for Copart, besides the fact that they own all these lands, there are also social pressures to basically limit the sale of all these different junkyards to new companies. It's something related to not in my backyard. So for Copart, they already own the land, so it is impossible for anyone to try and take it away from them. But for other competitors trying to buy in more new lands in cities, in areas with populated densities, it is impossible for them to do that. And besides that, Copart also offers the platform with the greatest liquidity. So they have the largest car auctioning platform in the entire world, and they currently hold around 40% market share in the US. They are sort of like in a duopoly with this other company called IAA. So when your car liquidity is high, what happens is your average sale price, your sale price of the car, is actually a lot higher than selling in the actual physical store, because when more people are bidding, it leads to higher prices. And so it doesn't make any economic sense for any insurance company to basically switch away from Copart. And that is also a mode for Copart. It is basically some sort of a network effect, similar to Amazon, where more people leads to more people, which leads to even more lock-in for them. So for Copart, it is a high quality business that I've been looking at. I'll probably release a video soon talking about this in full detail. Maybe you guys can stay around for that one, and we'll see how Copart plays out. The next comment, it says, this kid read one book on value investing and thinks he's Warren Buffett. He's finally realizing that his stocks are severely underperforming the market for the past 1 year, 3 years, and 5 years. So when it comes to the value investing book, I'm not too sure which book he's referring to. Maybe he's referring to this one here. This one on value investing. It's a decent read. Or maybe it's talking about a Warren Buffett book, which is this one. This one is interesting as well. Of course, it's another Warren Buffett book that I'm trying to, get some knowledge from. But of course, if you look into my portfolio, a lot of my holdings have actually outperformed the market. I hope you guys have found this one useful, and remember to invest safe.